Yeah, but the big question is, Judith, are investors willing to bet on Bernanke's bullish comments on the U.S. economy? Bernanke saying in his congressional testimony he saw signs of stability in the U.S. economy, but warned of more job losses ahead. Let's cross over to the Hong Kong newsroom where Dariusz Kowalczyk is standing by. He's Chief Investment Strategist at SJS Markets. Good to have you with us again, Dariusz. You know, Bernanke's bullish comments lifted most of the asset classes in the U.S., but not so much for Asian assets. I mean, we're just seeing marginal gains here in the MSCI Asia Pacific Index, and oil is pulling back, and there's a lot of risk aversion lifting the yen against the majors. How come?
Asian investors are more concerned about prospects for economic expansion in our region, and these are improving because of the acceleration of growth in China and some recent data out of countries such as Singapore. So, to some degree, independently of the US and driven by mostly Chinese demand, our region is expanding and boosting profit outlook for local companies. Having said that, obviously positive comments from Bernanke do matter for our investors, hence further gains. Remember that our region is up substantially so far this year. China, for instance, 97% year to date versus low single digits for the US and Europe. So further gains here are building on massive rally so far this year.
But, Dariusz, did we get any clarity from today's testimony on how soon the Fed's going to communicate fully or deliver that exit strategy to the markets to prevent inflation? Because he did say that he saw more job losses ahead.
Indeed, it seems that Bernanke is trying to guide down expectations of the start of interest rate increases in the U.S., saying that it will not happen anytime soon and that he has to be fairly convinced that job losses are a thing of the past. But remember, he also said he hopes that job creation will begin probably by the end of this year. That's why Fed Fund futures are still betting that the Fed will start raising rates in the first quarter of next year, and we believe that they will begin to do so already in December. In fact, what he said about his exit strategy suggests that we have to look at both the quantity of money supply and the cost of that money. And as quantity will not be withdrawn completely for probably many years to come, this extra quantity from quantitative easing, the Fed will still begin to tighten interest rate policy the same way that the Chinese are doing right now, injecting money into the system and already guiding open market operation rates higher. So I still think that the Fed will begin tightening sooner than the market expects, already in December this year.
Dariusz, you did here from the London studio. Do you think his assessment in terms of inflation risks is fair? He didn't seem to care a lot about that. It seems that Fed is much more concerned about supporting the economic recovery.
Indeed, he said that the focus of policy remains reviving growth because inflation is low, and he seems not to be worried about its upside in the medium term. I'm somewhat surprised by that because according to our forecast, CPI will turn positive pretty soon and run at 1.5% year-on-year by the end of this year and close to 3.5% by the end of next year, partially due to the surge in commodity prices. So I think that the Fed will be somewhat surprised by how fast inflationary concerns will return to the markets and to policy making, which is another reason why we think that they will start raising rates sooner than they are trying to tell us right now.
Thank you so much, Dariusz Kowalczyk from SJS Markets in Hong Kong.